All right, guys, so today we're going to go over some typical insurance coverages and what they mean for Exam FM. So first is term insurance, which is the entire idea that the lump sum is paid if the insured dies within a specific term. This term is typically 10 to 30 years. So you have decreasing term, renewable term, convertible term, typically meant for family protection, and this has low premiums due to the low probability of death. Underwriting is often more rigorous due to the early risk of death, and there's typically four risk classes: rated, normal, preferred, as well as uninsured. So the rated, normal, and preferred are the ones that could be insured at like a lower premium, especially for the rated ones. You could still insure them, but it would be at a higher premium. And underwriting, the entire purpose of underwriting is to avoid adverse selection, right? We don't want individuals who are more likely to die, more likely to have a higher probability of death to be insured. And so then we have whole life insurance, which is the entire idea of you get insurance for the remainder of your life. And this has regular premiums typically paid up to a maximum age of around 80. And you could actually surrender this policy. And if you do surrender this policy, you typically get some cash or slash surrender value in return. Typically, if you do sell this policy to a third party, that's what we call it as a stranger originated life insurance policy, which is when the third party buys and funds a policy to collect the death benefit. And so the third party pays the premiums and then they collect the death benefit at the end. One of the examples of this is viatical settlement, which is when a very ill person or very injured or someone who is old in age sells this policy to fund care or expenses, and then the third party will pay the premiums and then they will collect the death benefit at the end. But typically they do this in order to cover the immediate care expenses. We also have the types of bonuses. So why do we have bonuses or slash like dividends in the first place? Is because obviously premiums are often higher than anticipated because insurers want to make sure that they cover future anticipated costs. And so the reason for that is then they charge higher premiums for those additional costs. And so what does this mean? This means that in return, what they do is they share the profits with their policyholders. And so this is what we refer to as a participating or at par or profit insurance, is the insurance company shares the profits from the invested premiums with the policyholders. So this comes in two different ways, either cash dividends or bonuses. Bonuses are typically less flexible, they're more profitable generally for the insurer. They're harder to understand, but they are more profitable for the insurer. Cash dividends are flexible, easy to understand. They are very costly to the insurer and they could be taxable. So you can think of cash dividends as something that's good for the insured, and bonuses is something that's profitable for the insurer. We also have riders, which are like specific features or benefits that are added in addition to the entire whole life insurance policy. Accelerated death benefit, which you get paid earlier upon a terminal illness. Terminal meaning that it is like your last stage, it's unrecoverable. Premium waiver on disability, these premiums are waived while the insured is disabled. Critical illness, lump sum is paid upon an illness diagnosis. Family income benefit is when this income is paid to the family after the death of the insured. Joint and multiple life, so these are different versions of the life insurance. Modern insurance contracts, one of the key features of modern insurance contracts is it combines this insurance element with this investment element. So the premiums are invested into some, either it could be a fund or it could be for some asset unit, and and then the policyholders, they share those investment profits. So that's one of the main features of modern insurance contracts that's different from the traditional one, is it has a significant emphasis on this investment component. Also, it has a large flexibility on payments. Uh, some premium payments can be skipped depending on the insurer, depending on the policyholder and their needs. And so you can think of modern insurance contracts as very flexible in that regard. And we have unitized with profit, and then we also have equity linked. Unitized with profit is sort of similar to the at par or the profit insurance what we talked about, where premiums purchased premiums per notional units in an internal portfolio. So this can actually only increase in value or stay the same, right? They can only increase in value or stay the same. The value does not decrease. Contrasting this with equity linked, this is actually directly related to the performance of an actual fund, So the benefits could increase or decrease, right? Whereas for unitized with profit, they can either increase or stay the same. They don't decrease. So that's one of the key differences between these two types. And then we also have some like sales and distribution concepts. Is a front-end load is typically when the broker commissions are paid from the initial premium. So typically, first year premium is typically they get a higher percentage of that. And annuities, one of the main things, no underwriting for annuities because one of the things that contrasts annuity with the whole life insurance is you actually don't want the insured to live as long as possible. And then we have one of the major ones here is disability income insurance. So how this works is while the insured is healthy, get paid, right? They pay the premiums. And then once the insured enters a period where they are disabled or they become disabled, they're unable to work, then there's this waiting period where the insured has to wait, or it's also called elimination period, where they have to wait like 30 days or 2 months before the actual benefits start to kick in. So typically it's around 30 days, 60, sometimes it's even a year. And then we enter the benefit term, which is the maximum duration of the payments. So sometimes it's 2 years, sometimes it's like up to age 65. And then the benefit amount is typically it's around 50 to 70% of the income to actually incentivize return to work. And then the off period is sometimes an individual may be disabled, may be unable to work, but then they return back and then they are disabled again. The off period is to ensure to provide a distinction between which two periods can this entire policy be counted the same. So if there's a period where, if, for example, if the off period is, let's say, 2 months, and the insured then becomes is able to work, but then also becomes disabled after those 2 months, then those would be considered two separate terms. So then you would have to apply the entire waiting period again and the entire benefit term again. But if it's less than the off period, so if the off period is 2 months and then they become disabled again within those 2 months, then you don't count the elimination period or the waiting period, and then the benefit term still applies as if it's like a single term or a single policy. And then we have long-term care insurance, which is the entire idea of services needed to aging or chronic impairment. And then let's see and then insurance company structure. So insurers are owned by the policyholders, so the profits are shared with them, whereas proprietary, they're owned by the shareholders. There can also be some, policyholders with profit policyholders, but typically proprietary insurers are owned by shareholders. Profits go to investors, whereas for mutual insurers, they're owned by policyholders. And then structured settlement is the entire idea when one party injures another party and they're responsible for their payment. And again, there's a lot of nuance to this. It depends on the amount of injury or like what this injury prevents the other person from doing for certain periods of time. And there's also like a maximum medical improvement. So once the recovery is stable or up until the point that they are able to recover to some extent, are the benefits, like interim benefits get paid, and then after that, then a final settlement is decided upon. Pension is all about like setting up for your retirement funds, and so there's two main types: defined contribution and defined benefit. Defined contribution is a the percentage of the salary, and then defined benefit is like a fixed amount or like a fixed benefit amount. And typically it's years of service times accrual rate times pensionable salary. Now, this pensionable salary can be defined in many different ways. Sometimes it's like the last 3 years of service. Sometimes it's the entire career. Sometimes it's the entire career adjusted for inflation. So there's many different ways to actually come up with the pensionable salary. And one of the other things as while going through FAM exam that you want to note down is you want to keep a track of like your common mistakes that you make while you're going through your practice exams. So while you're going through the practice exams, you're probably going to encounter some key mistakes that you do repeatedly. So one of the things to note is you want to write these mistakes down. Like what is something that you're constantly doing wrong? So these are some of the mistakes I've been making, right? I've been keeping track of those mistakes. So like just going through these, one of the questions had to use some trial and error. There wasn't an algebraic solution, so that was something that could have been a lot faster if I just had known and attempted to just try in the answer choices. So that was a framework of thinking. And if you know how to do a question and you do it and you don't get the correct answer, it's best for you to actually just move on. Sometimes you may be stuck into like a frame of thinking or a frame of mindset, and you don't want to, and internally you don't want to move on to the next question, but you have to realize that it's very unlikely in that times-based environment, in that pressure-based environment, that you're actually going to come up with like something that's different from what you're already thinking. So you have to just move on to the next question, or maximize the amount of points that you can get from early on. Expected value of gross future random variable is not the present value of the future death benefits. Right, so this was a incorrect calculation, led to the incorrect 95 percentile. So these are just some mistakes. Another thing to note: present value of the future expense premiums is the expected present value of future expenses minus, which is equal to that of the loading, right? And then recursion with life expectation. So one of the mistakes here was that you have to treat like even x plus 7 expectation of the life at x plus zero point 0.7 still means that the current age is x plus zero point 0.7. So even if they do survive to x plus 1.2, right? That's not one completed year, because it's still not after 1 year of x plus zero point 0.7. So you have to remember that x plus zero point 0.7 is the current age. MLEs, when you're doing the product of them, make sure to cancel out all the terms that are constants. Sometimes when you're doing MLEs, they may come out to be like super nasty, like equations that you have to take the derivative of. But if you just sometimes just cancel out the constants, because derivative of constant is a zero if you take the natural log of it, right? Derivative at zero, it's not going to make a difference when you're doing the optimization. Then you can just cancel it. Don't use tabular integration. So I know some questions like, have you used tabular integration? I don't think it's necessary for you to actually know that, just in terms of time and in terms of like the amount of time that it would take to do the question. So sometimes it's just best to use your trial and error on those and judgment call on those questions. One of the questions asked for like a decreasing, it was like a decreasing whole life. And one of the ways I got the answer was, instead of a decreasing whole life, if I just think of all of it was a decreasing from like five to right from five, and I calculated just two, right? If all of them were two, and what I got was, I know that this has to be greater than if all of them were two, and the only answer choice that made sense was the one that was greater than all than the answer that I got with all of the payments being two. So that's one of the things, is you want to be very efficient with your calculations. Formula for t-var log normal is expected value of x times the CDF of the sigma minus z. So one of the mistakes was mistake the z for the 2. And then trended and developed losses over premium at the current rate level. So this is the L over P when you're doing the loss ratio, or when you're calculating the average change in rate. When drawing out the loss triangle, you want to make sure that you do the development year zero first, like you draw out the development year zero first, and then you sort of create the triangle from there. And then sometimes they may give you in like different formats. So you want to make sure that you're properly making the entire triangle based upon whatever information that's given. And then if when you encounter life tables, or like those, right, selected mortality tables, try converting them to L's and P's. That's often easier to use. If it's like a question like calculate, probability of x plus zero point 0.7 dying between this time period and this time period, try converting that. Always be converting that to L's, right, and P's and number of lives. That's what I find is most easiest. Maximize your score early on. So even if you know how to do a question, the more momentum that you can gain from getting a bunch of questions you know right very quickly will set you up for success further on, even tackling some of those harder questions. So, and again, if you don't get the close enough answer, leave it and move on. This is a time-based game, 3 hours and 30 minutes. It's not something that's like you have an entire 6 hours to work through, right? This is one of the main elements of this exam is time. All right, so I think that's about so these are some of the main points. And again, one of the best practices is to like keep a track of what these mistakes that you're constantly getting wrong, right? These mistakes that you're doing and the things that you're constantly not doing correctly. And you want to look over them and review them as much as you can to avoid those. So that was one of the FAM tips for today. I'll see you in the next video.